2, analyzing transactions. Okay, I'm using a new package or software package to record this, so if I make mistakes, you can giggle a little bit, okay? In this short video, we're going to look at the characteristics of an account and a chart of accounts. So, what is an accounting system? Well, an accounting system is a group of categories that are put together to keep track of the money being used by in a business. And those categories are assets, liabilities, and owner's equity. And each one of these categories have accounts in them, such as cash, supplies, and land, or accounts payable, capital, and then you've got income statement accounts, fees, wages, rent, supplies. These, right here, are accounts, and that's how we keep track of the money being spent or the assets being bought and sold in a company. And it's called an account. So cash is an account. So a group of accounts for a business entity is called a ledger. Now, this is where we have all of the accounts grouped together in one place. That's a ledger. And the list of accounts in the ledger are called the chart of accounts. And a chart of accounts looks like this, okay? You have assets. Those are resources owned by the business. And assets have accounts such as cash, supplies, accounts receivable, buildings, things that we own, things of worth. Liabilities are debts owed to outsiders, creditors. And examples of liabilities are, accounts payable, notes payable, wages payable. Hint, it has payable at the end. Then you have what they call owner's equity, and that is what's left over. If you take the assets minus liabilities, it will give you the owner's equity. Very much like buying a house. You will have a mortgage minus the interest, gives you the principal, and then how much the house is worth. So if the house is worth $200,000 and you only own $100,000 on it, you have equity of $100,000 built in. Well, that's kind of what owner's equity is. You'll take what you own minus what you owe to get the owner's equity. And then there's a draw account down here that's used for when an owner withdraws money from the business for their own use. It's not very different than what your personal account is, only we're using some different terminology. We also have revenue accounts and we have expenses. And these are income statements, income account statements, and we use that to figure out how much money, what the net income of the business is. And that would be revenues minus expenses equal net income. So when you get all down to it, right here is your chart of accounts. Now, assets are usually in the 100 or the tens area. You'll notice the numbers to the side. Liabilities are in the 2s, 20s, or 200 area, even 2,000 area. Owner's equity will be numbered in 3 or 30 or 300 or 3,000. And then revenues and expenses will follow that with a 4 and a 5. So your assets here are balance sheet accounts, which tells you how the business or what assets a business owns at any period of time. And the income statement looks at how well the business is using the assets, the revenues coming in and the expenses, and if you net these two, you get the net income. When you do this and you close the accounts, that net income obviously is equity and gets added to the owner's equity here. I'm sure that's clear as mud. We will do a lot more with this. Here's a new tool I want to introduce you to. It's called the T account. A T account is an accountant's tool. Most lay people do not use these. These do not show up in reports anywhere. They're simply used to help you keep track of accounts as you're going through. And it also helps an accountant get a visual of what's going on. So a T account looks just like what it says, a T. And then it has a title. The left side of the account is a debit. The right side is a credit. Now, I'm going to show you why that's important here. If we come right here, here's the cash. This is our title. Cash is an asset, so it always has a debit balance. If it doesn't have a debit balance, you don't have any cash. You are overdrawn. So, let's kind of follow these transactions that show up here. A was the owner's initial investment, so we have increased the cash by $25,000. B was when the owner bought land and paid a check for it, and that subtracts from it. So at this point right here, there's only $5,000 in this account. Now D, they added $7,500. I would say that was probably revenues. So now we've added to it, and then E, F, and H were all checks that were written out that is subtracted. If you net these two, which means taking and adding this and then subtracting this, you should have a debit balance of $5,900. And you will use this continually. And we'll do another exercise that will help a little bit on that. So that is the first introduction of analyzing transactions in Chapter 2, and we were looking at terminology, the characteristics of an account, and the chart of accounts. Thank you. We will talk more in the next one.